welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The fixed income market has been going through an amazing amount of chop and churn over the last 15 months, and now it has reached an interesting milestone. There is a new product in the market, and one that has been spoken about quite a lot over the last few months. I am talking about the Bharat Bond ETF. Now, why is this product interesting? Because it's the first time that we will have an ETF or an exchange-traded fund which will use the underlying index, which is the Bharat Bond Index, that comprises entirely of CPSEs or government-run central public sector undertakings. So the investment is only going to go in bonds that are issued by the central government. Does it make the cut? Not. What's the good, bad and ugly about this product? Well, to understand it threadbare, I have with me Ashish Shankar, Head of Investment Advisory at Motilal Oswal Wealth Management. Ashish, always a pleasure to have you on the show, so welcome back.
To be on the show, Surabhi.
Speaking at an interesting time, the year is also drawing to a close, and then, you know, we've had so many ups and downs in the fixed income market, and then comes the Bharat Bond ETF. Right. Is it going to allow us to end the year at least on a bit of a high?
Yes, I think it's a very interesting product, and the timing is also very right. If you look at what's happened, a lot of these credit funds have troubled investors. We've seen downgrades and we've seen markdowns in credit funds, and people are really scared because they thought the fixed income investments are very safe, and to see this kind of volatility really shakes you up. So it's come at a time when there is extreme risk aversion in the market. People are trying to put money in public sector banks, or let's say the good quality private sector banks. So an ETF where the underlying is government enterprises, that too AAA, at least it takes away the credit risk aspect of fixed income investing.
Okay. Well, there are two categories. If I talk about retail investors, there are two categories of investors. One who moved to debt funds, and then maybe they got bruised, as you're saying, because of the events of the last 1 year. And the other category, which is still happy and comfortable with their fixed deposits. Right. For which category of investors do you think this could be at least an interesting idea to consider?
See, couple of things. One, this comes in an ETF wrapper, so it gives you the long-term capital gains benefit. So there are two plans, as I understand. There is one plan which matures in 2023, and there's another plan which matures at 2030. So essentially, you have a three-year plan and you have a 10-year plan. Now, both these plans are interesting because if you spend more than 3 years in this product, you're eligible for long-term capital gains tax. So anybody whose taxation is greater than 30%, so essentially you're talking about HNIs, for them this makes a lot of sense. For people where the taxation is probably 10% or lower, who do not come into the tax category, bank deposits probably are a better bet, because then you're just looking at the gross yield. You're not looking at the net yield, that is net of taxation.
Net of tax, yeah.
Net of tax. Okay. So it's an interesting product, albeit I would say that in the three-year category, you do have many other substitutes. But the longer term 2030 option is very, very interesting, because I don't think there is a comparable product in the market, except for maybe tax-free bonds.
Okay.
And yeah.
Okay, so that's the first things first. I mean, a lot of people do look at an alternative to FDs, because FDs are not tax efficient, especially if you're in the 30% bracket. I get that. Right. Another two types of risks. I want to come back to the drawing board as well when it comes to fixed income investing. You spoke of credit risk.
Yes.
Which in this case is not there, because most of these bonds are going to be AAA rated. They're going to be at least backed by the sovereign. It's Government of India companies. What about interest rate risk?
Yes.
Because we're in an era where rates are fluctuating. We don't know if there's another cut from the RBI. How does a bond ETF like this one react to changes in interest rates?
Right. So to explain it in a very simple manner, let's assume you put money in a 3-year bond and you put it at 7%. Let's say the interest rates rise to 7.5%, and the bond has to get repriced to 7.5%. Ideally, the price of the bond has to go lower for the new investor to get 7.5%, because interest rates have adjusted. So bond prices and interest rates are inversely proportional. So when interest rates move up, bond prices go down. When interest rates go down, bond prices tend to move up. But this worry is for somebody who wants to exit in the interim. So let's say I buy a 3-year bond, and if I want to exit after 2 years, then where the interest rate is after 2 years is of importance to me. But let's say if I buy a bond for 3 years and I want to stay in the bond for 3 years, then this risk really doesn't matter. So if I lock in my money at 7% for in a 3-year bond, I will get my 7% after 3 years. So in the three-year ETF, the interest rate risk will be minimal because the bonds mature after 3 years. In the 10-year ETF, let's say if you want to exit after 4 years, then yes, the interest rate risk does make a difference, because after, let's say after 4 years you want to exit the 10-year ETF, if the interest rates are up, you may get a return which is lower than the return that you logged in while investing.
Okay.
If the interest rates are down, consequently, you may make a slightly higher return.
Okay.
Right? So
it will depend on when you really want to exit. If you're going to hold it till maturity,
right,
then there is minimal interest rate risk, because whatever is indicated, you should get ballpark.
Actually, there is no interest rate risk if you hold it till maturity, because you should get what the underlying yield of the bond is.
And I'm guessing this is the concept of target maturity. So if you read literature around this product, the Bharat Bond ETF, there is this concept of target maturity that they speak of.
Yes.
And I'm guessing that's what this is. There's a 3-year product. You can go for the 3-year ETF.
Absolutely.
Or the 10-year
Absolutely.
ETF as well.
Absolutely.
How to decide between 3 and 10? One is obviously going to be, when do I need the money?
Right.
If I don't need the money for the next 6-7 years, can I take the 10-year option? Will the interest rate risk be mitigated, because I'll have to then hold on till 10 years? How to decide which one to choose?
See, if you look at the savings pattern in India, people keep fixed income investments for very long periods of time. If you look at the tax-free bonds which got issued for 10 years, 15 years, 20 years, all of them got oversubscribed. So people keep fixed income money for very, very long periods, even these insurance investment products. So the 10-year ETF, according to me, should be an integral part of any long-term fixed income portfolio. Okay. It's a no-brainer for me, because the expense is very, very low, and the yields are closer to 7.5%, which is a very good yield. And I'm really hoping that it helps us expand the mutual fund market. Because if you look at the number of mutual fund folios, is I think barely 2.1 crore folios in the industry. Whereas if you look at the bank deposit market, it's a massive market. Probably 70-80 crore bank accounts are open. So I'm just hoping, with the creditors going away and the underlying investments going into government bonds, it widens the mutual fund market rather than eating into the share of the existing. The 3-year option, frankly, there are other funds which are also very good. So if you look at some of these PSU debt funds, PSU banking debt funds, their yields are closer to 7% net of expenses.
So you're getting better.
Absolutely. So you're getting better value for your money, and they're open-ended. So you don't have this risk of trying to sell in case you need the money before maturity.
Okay. All right. So those are some of the basic pointers. I mean, essentially the takeaway is that if you're looking to save tax, if you're in the high tax bracket, this is a good product to consider. And especially if you can wait till the end of the maturity period, then it's something you should definitely consider. We need to take a break, because now we need to understand how to invest in it. There is obviously the NFO route, but then remember, this is an ETF, which means you can keep buying and selling units even on the exchange once the ETF lists. How will that function? How do you go about it? We discuss it on the other side.